Hey everyone, it's John. It's time for a general market update. It's May 19th, 2023. I'm recording this approximately 11:15 on Friday, the 19th. Many charts that you'll see in the presentation were cut last night, so they're from Thursday's close. Reminder, this is a Rain King LLC presentation, and I'm an amateur individual growth stock investor, not affiliated with MarketSmith or IBD. So here's our agenda. We'll talk about the big picture, review some internals, touch upon a few strong sectors. We'll do a summary, and then I have a special event announcement. So the big picture, this is a chart from last week that I used, which was just showing on a weekly basis the NASDAQ and just using some Fibonacci's from the COVID lows, as well as the rebound that we've had, and identified really this resistance zone that we've been experiencing that goes all the way up to the top of about 13,150, which is about a 50% recovery of the decline. And we looked at the daily chart and we said we had just crept up to the highest level since September of 2022. And these sell-offs that we were having were getting smaller and smaller and smaller and tightening, and that we might get above this resistance level and maybe we get a bit of a rally. So here's the updated chart. This is the NASDAQ, and also at the bottom is the new highs, new lows. And here's the resistance zone we've been talking about for many, many weeks. And you can see how we pushed through that. And we've also noticed that we finally got net new highs on the NASDAQ yesterday. So we have a little bit of a heartbeat on the net new highs front. A couple of weeks ago, I put out this tweet that there was all this positioning on the bearish side that maybe we could get a rally to really take hold if we get above the resistance. Now, we're getting this push above resistance, but it still seems to be confined really to the mega caps. But there is a couple signs of improvement, which we're going to cover. So let's go to the internals. So this is the New York advanced decline line as of yesterday. We've been in this downtrend. The S&P in the upper pane here is trying to get through its resistance at the 4,200 level, but the advanced decline line is woefully behind. This advanced decline line needs to really improve substantially in the next few weeks to get way up in this zone to really confirm any sort of breakout in the S&P. So lots of work to do. Advanced decline line here on the NASDAQ composite. You'll notice that it's been just woefully weak. We're at the lowest levels in the advanced decline line for the NASDAQ in a year, even though we see the index pushing higher. Obviously, it's concentrated in some of the big FANG stocks and AI leading stocks. Now, on the small cap front and the mid caps, the small cap Russell 2000 is on the left. And I guess you could call it a baby step, but we've pushed above the red line, which is the 50-day moving average. That's a very good first step. We need small caps and mid caps to start joining this rally. Here, the mid caps on the right is very similar. It's cleared the 50-day moving average, which is the beginnings of potentially a rally. I believe this morning there has been a little bit more follow through with these, so that's encouraging, but there's still a lot of work to do to broaden this rally. So this chart is taking the ETF for the consumer discretionary sector, XLY, and dividing it by XLP, which is defensive staple stocks. So we're looking at the relative performance. You can see that consumer discretionary has been woefully underperforming most of 2023. And we seem to have broken the downtrend line. I would say this is another baby step. So we're starting to see some outperformance over the defensive sector of the staples. That's positive, but we'll have to see if we can continue to build upon that. Another couple of ETFs. This is IWF, which is the Russell 1000 Growth divided by the Russell 1000 Value ETF. So what we're basically trying to point out here is that since 2023 started, the line's rising, which means that growth is outperforming value in these two ETFs. So It's interesting because, there is rotation going on in this market over the past 4 or 5 months, but so far it's been really limited to the mega caps, as well as there are a few other select growth names that are doing okay. But there is some money flow into growth, but we really need to see it broaden out. As we mentioned, we're not getting new highs. We're not getting some of the other things that we want to see in the advanced decline lines. So some strong sectors. This is the SOX index, which is the semiconductor index. You'll notice that since 2023 started, it jumped out of the gate as a leading index. And then it went through a kind of a sideways to down period. It didn't look too good in here in late April. The semis looked like they were really going to roll over. The stocks were getting hit pretty hard, but they've recovered very strong over the last couple of weeks and actually have gotten up. This index has gotten up to close to new highs. So there are some very strong charts within this sector. RMBS, NVIDIA, Excelis, as well as Supermicro are all acting very, very strong. But that being said, there still are a number of other semiconductor stocks that are not really advancing. They've gone back into bases or they've turned down. So it's pretty selective, even though the index is going up based on some of the weightings of some of the members in the index. So this is a chart of RMBS. This is a daily chart. I wanted to just show this to illustrate a couple of different points. One is RMBS has been a leading stock since the beginning of the year. It broke out of a base back here, had its first pullback into the 50-day, then it rallied, then it had another pullback into the 50-day, it had a strong rally, and then we've pulled back again into the 50-day. And 2 weeks ago, this really looked pretty nasty in here, the sharpness of the sell-off. It appears now that that was a shakeout that came down and undercut the 50, and we get this sharp V recovery. And one of the clues that it was a shakeout was the volume on the way down was large, but the recovery volume was even bigger. So there's definitely some institutions snapping up more shares of RMBS in here, and there's been continuous power, and it's gotten quite extended. But I wanted to show this because I think it illustrates some key things about shakeouts, and I'm going to do a GMU extra on shakeouts that'll be coming up in the next couple of weeks. One of the things I like to look at is when you're in an uptrend, looking at the undercut of the 50-day. You can see the first undercut had only a very, very little undercut of the 50-day, showing that there wasn't much selling. You'll notice that the second undercut was a little deeper than the first undercut. And you'll notice that the depth of this third one was even deeper. And this is really attributed to, as the stock becomes more obvious in an uptrend, more people, retail investors, are probably getting in the name, and institutions need to shake out the stock to grab more shares without pushing up the price. Now, in an uptrend, usually the first two trips are viable, and they were in this case. The huge volume we've seen was encouraging that RMBS is still a leading semiconductor stock. And it didn't really trigger any sell rules. The sell rules that I use at the 50-day moving average were not triggered on a weekly basis in this shakeout. So you all have your own rules about the 50-day. Maybe we can talk about that at a future update. So this is the Home Builders Index, the XHB. Again, this has been coming out of a base, and it broke out recently. We've talked about this a couple of weeks ago. We're seeing strength in the home builders. Some of the strongest charts are Green Brick, Lennar, Taylor Morrison, KBH. I encourage you to look at some of those charts. They're extended now and they're running, but there is strength in the home builders. So as the summary, we are continuing to see rotation into big cap tech, leading for the most part is a narrow rally. It's a very positive sign that semiconductors are starting to reemerge as leadership, though I'd like to see more of them participating. The other thing that's important is we talked about the home builders. They're doing well. And this week in particular, we saw the defensive sector ETFs turn lower. The staples and healthcare and utilities all came down. So that's a positive development. We don't know if it's just a short-term pullback or more of a trend yet. We mentioned the NASDAQ is reaching some of its highest levels since the September, October lows, but we want to see the S&P really confirm the move by breaking out of its range, which it's trying to do. It would be very important if the S&P could get and hold above the 4,200 range. So it still remains a questionable market. Is this more on again, off again activity where we just rally for a few days and we come back and it just chops around? Or is this a real rally? We still need to see the advanced decline lines improve dramatically to confirm these new highs in the index. And we're not even close yet. The net new highs, we've been following this closely. We're not anywhere near showing a trend of net new highs. So those are really two big headwinds, at least to me, that will determine that this is really not a real rally until we see improvement. All we can do, though, is interpret what we see and be very, very careful about how you approach the market right now. It's still very much a go slow environment to me. I think the same exposure levels that we had last week are, I think, reasonable, 0 to 20%, or you could be in all cash. Yeah, it's also worth noting that buying strength, has not worked in the market for over a year, probably longer. And buying pullbacks can work, but I think if you're going to do that, you really want to make sure that you have a defined technique or strategy or rules about how you actually enter on a pullback. Don't do it willy-nilly. Really have a strategy. Buying strength has been tough. I generally, in the past, have been a buyer of strength, so I've had to really change and contain myself not buying strength. And I do have a strategy for pullbacks that I try to implement when I can. So I had heard a quote this week that I thought was kind of interesting that I'll use this week as our parting quote. A fund manager was asked about, are they bullish or are they bearish? And they said, I'm too anxious to get short, but I'm also too nervous to get long. So the point is the cross currents continue. It's not decisive in either direction, and just be careful with your exposure levels. Some of you have been sending me topics for GMU extras. I really appreciate that. I'm taking notes of them. I'm going to try and do some, in the next few weeks. So if you do have ideas, keep sending them to me and I'll see what I can do to try and incorporate them. Now, the special announcement I wanted to make is I wanted to give you a heads up on a Boston IBD meetup event. In June, I'm going to be doing a special lecture series on Jesse Livermore's life and his trading career. So I'm going to be sending out a tweet probably early next week, which will give you access to a 2-minute video where I'll go into detail about what this series is all going to be about. But it's going to be a 3-part lecture series, and I'll also include the link in the tweet. So look for that early next week. I think people will enjoy this if they have any interest in Jesse Livermore. So that's the general market update for May 19th, 2023. And there's where you can find me on Twitter, YouTube, and email. We'll see you soon, and hopefully everybody is trading well.